All right, welcome to The Explainer. Today, we're getting into a topic that honestly is the real secret to long-term success in investing. And here's a hint, it's not about finding that next explosive stock. It's about something way more fundamental, making sure you can actually stay in the game long enough for your money to grow.
So let's just kick things off with a pretty brutal truth, right? Most investors don't actually lose money because they pick terrible stocks. Nope, they lose money because they are absolutely awful at managing risk. Your biggest threat isn't always a bad company. It's how you handle the downturns that are bound to happen.
And this right here, this really gets to the heart of it. It's the amateur versus the pro mindset. You see, on one side, you've got this trap that so many people fall into, thinking that managing risk is somehow going to kill their returns. But the pros, they know the complete opposite is true. They use systematic risk control to unlock higher returns over the long haul.
Okay, so here's the game plan for today. We're going to look at why most investors fail. Then, we'll uncover some hidden dangers in your portfolio. And then, we'll get into the good stuff, the pro solutions, how to size your bets, how to spot red flags, and how to get ready for those inevitable market crashes.
All right, section 1. Let's dig into the real reasons so many investors fail and what we call the amateur risk management trap.
Okay, moving on. Section 2 is all about the 8 hidden dangers. And what you'll see is that pros know that risk is so much more than just watching a stock price bounce up and down.
So here they are, the 8 big types of investment risk. And yeah, they're all important, but for today, we're going to zero in on a couple that just ambush retail investors time and time again: sector concentration and, you guessed it, behavioral risk.
You know, theory's fine and dandy, but it doesn't really hit home until you see it in action. So let's make this super real. We're going to take a look at a sample portfolio and see how these dangers can be hiding in plain sight.
Now, when you first glance at this portfolio, you might think, hey, looks pretty good, right? Diversified across 4 different sectors. But take a closer look. That 40% chunk in IT stocks, that's not diversification. That's a huge, glaring bet. Even if you own 4 amazing IT companies, what you've really done is make one giant wager on a single industry.
Yeah, this is a massive red flag, a huge one. See, professionals, they try to keep any single sector well below 20%. And why is that? It's simple. With 40% of your money tied up in IT, a downturn in that one industry is going to absolutely devastate your entire portfolio. It doesn't matter how good your individual companies are. You've diversified the stocks, sure, but you completely forgot to diversify the sector risk.
All right, section 3. Let's talk about how to size your bets. This leads us right to a fundamental tool for the pros, the 1% rule.
1%. This single number might just be one of the most powerful tools you can ever use to make sure you survive long enough to actually win in the market. It sounds almost too simple, right? But its power is just immense.
So what is the 1% rule? Look, the whole point of this rule is not to limit how much you can make, not at all. It's to make damn sure that no single bad decision can ever wipe you out. Think about it. If you only risk 1% on any single idea, you could be wrong 10 times in a row, and you've only lost 10% of your capital. You can bounce back from that. A 50% loss on one terrible bet, good luck recovering from that.
And here's exactly how you put it to work. It's just 3 simple steps. So let's say you've got a $100,000 portfolio. Your risk capital, that's 1% of your total, is $1,000. Now, let's say you decide your stop loss, your I'm out point, is a 20% drop. You just divide that $1,000 risk capital by that percentage. And boom, the answer, $5,000. That's your maximum position size for this investment. It's a simple, powerful formula that stops any single stock from sinking your entire ship.
Now sure, the pros use all sorts of advanced methods. You've got things like the Kelly criterion, which can be super aggressive for high conviction plays. But for most of us, the 1% rule really offers the perfect blend of safety and simplicity. It gives you a clear, systematic way to get your risk under control before you even hit the buy button.
Okay, section 4, monitoring for red flags. Because getting your position size right is just step 1. Risk management is an ongoing job. You can't just set it and forget it. You have to keep an eye on your portfolio for dangers that might be creeping in.
Think of these as the warning lights on your portfolio's dashboard. Seriously, we've already talked about sector concentration, but you also got to watch your single stock exposure. If one of your winners gets so big that it's now over 8% of your portfolio, hey, that's great news. But it's also a brand new risk you have to manage. And another big one, check for high correlation. In plain English, do all your stocks basically move up and down together? Because if they do, you're not nearly as diversified as you think you are. And finally, and this is maybe the most important one, you have to have to have a predefined exit strategy for every single position you own. Knowing when you're going to sell for both a profit and a loss is what saves you from making emotional, panicked decisions in the heat of the moment. And that, my friends, is the ultimate portfolio killer.
All right, Section 5. Preparing for the big one, market crashes. A key technique pros use is called stress testing. You don't wait for the hurricane to find out if your roof has a leak, right? You test your portfolio against the storms of the past.
So let's go back to that portfolio from earlier, the one with 40% in tech stocks. Let's wind back the clock. How would it have held up during the dot-com crash of 2000, when tech stocks just fell off a cliff?
Minus 42%. A devastating 42% loss. And that damage was driven almost entirely by that one single risk we identified, the sector concentration. Years and years of gains could have been completely wiped out in a matter of months.
Okay, let's run another simulation. What if, instead of IT, that portfolio had its big 30% concentration in banking stocks? And let's throw it into the fire of the 2008 Great Financial Crisis. Minus 42.5%. The result is just eerily similar, isn't it? Another catastrophic loss that could easily take a decade or even more to recover from. And this proves the point perfectly. The risk wasn't the specific sector. The risk was the concentration itself. This is why stress testing is so valuable. It exposes these huge vulnerabilities before they become your reality.
Okay, last section. The true power of risk. This is where we bring it all together and talk about that final crucial shift in your mindset.
So here's the crucial point. The math of losing money is just unforgiving. It is brutal. A 50% loss requires a 100% gain just to get back to where you started. Think about that. Preventing a big loss is so much more powerful and, frankly, mathematically easier than trying to chase a huge gain to make up for it. Risk management isn't about killing your returns. It's about protecting your capital so it has a chance to compound over the long run.
So this is the fundamental question you have to ask yourself. Your portfolio, yeah, it's probably built to capture gains, but is it built to survive? Because at the end of the day, survival is the only thing that guarantees you'll be in the game long enough to actually win. And we'll leave you with that to think about.